Welcome, everybody. We'll be getting started shortly. We'll be in a couple of seconds. We'll be getting started again. Good morning, everybody. Hey, good morning, everybody. Let's get started. My name is Barry Sunshine. I'm a senior tax partner at Janover. I'm going to be today's moderator, and today we're going to be covering the employee retention credit, which is a really very hot topic in the world today. We'll also be covering some new developments in the payroll protection program, as well as we're going to cover some of the individual tax provisions relevant to the new tax laws. This is the next installment of the Janover webinars. Just to let you know that after today's webinar, we're going to have one on Thursday, the 28th, which we're going to be covering the real estate outlook in the world. And then on February 4th, we're going to be continuing going back to the new developments and current developments on the PPP, Payroll Protection Program. We're going to cover more on the employee retention tax credits, and we'll also be covering the business tax provisions. Today, our speakers are Chris Zangali. He's going to be helping us out with the payroll protection. He's a principal in our consulting group. We have Gianluca Carrabs, who is a principal in our tax department, as well as Amanda Wasserman, who is a manager in our tax department. Today's webinar is going to be recorded, and so it will be listed on our website at some in a few days, and you can re-listen to it. It's also noted that we covered the PPP prior to this, and it's also on our website and recorded, so you can listen to it as you go through. We also have on February 4th, as I said before, we're having another installment of the new developments. I anticipate the Treasury Department and the IRS is going to be coming out with a lot more provisions on the employee retention tax credit. And the SBA is going to be coming out with some rules on the payroll protection program. We'll be covering a lot of those things. That's next slide, Chris. We'll be covering these things on the employee retention credit, who's eligible, how to qualify, how much you're entitled to, and how does this work interplay with the PPP. Then we're going to cover the payroll protection program and the individual tax provisions. There's a Q&A at the bottom middle of your screen. If you have any questions, please post it there. And throughout the program, we will be monitoring the Q&As. We'll be answering them. If they're great questions, which a lot of them are, we'll bring them up here and we'll cover them during the materials, or we may just answer the questions online. So we have that. The program is going for 1 hour, so we anticipate being complete at 10 o'clock. Next slide. This program is all coming from a tax law that was signed December 27th, which was called the Consolidated Appropriations Act, the CAA. which provided $2.3 trillion of a price tag. $900 billion of it is COVID stimulus relief provisions, which included the expansion of the employee retention tax credit. There's been a little bit of momentum on this area. This is very, very big money. This hadn't been focused on the first go around, because in the first round, people had to choose, a small business had to choose between the employee retention credit and the PPP. Most businesses went to the PPP, so the employee retention tax credit was really not looked upon that carefully. In this new bill, they allowed PPP recipients to also get the employee retention tax credit. So this is a very huge item. So, and Luke is going to be leading us in this in detail. So this is very important. And then the bill also provided some unemployment extensions of unemployment and other provisions from it. So these are all very good things. Next slide. Before we get started, we have a little polling question. The first question that we have is, do you think your business will qualify for the employee retention tax credit? One is yes, we ran the analysis to determine if you qualify. Maybe, I have no idea how to determine if I qualify, and no, I do not qualify. We look at this as a polling question just to get a sense of our listeners and seeing how deep we're going to go into the program and see how broad important this is. Yeah.
So Barry, we have about 75% of or about 80% of the vote in. So I will, let's cut it here.
Okay.
And just look at the results quick.
So the answer is 50% says maybe, I have no idea how to determine if I qualify, which is first and fundamentally why we're doing this seminar, because we're trying to get a better understanding of how our clients and friends and other small businesses qualify for this employee retention tax credit. It's a very important thing. And without further ado, I want to introduce one of our speakers, Luca. Go ahead, Luca.
Thanks, Barry, and thanks everyone for being here. We hope, to give you guys some insight into the ERTC, the expansion, as well as, the retroactive portion of this credit. So as Barry said, back in December, with the enactment of the Consolidated Appropriations Act 2021, they changed some of the provisions under the CARES Act, including the employee retention credit, which has been expanded and extended under this new law. So now eligible employers they have until June 30th of 2021 to claim this tax credit on wages paid to employees they retained through this pandemic. In addition, as I believe Barry just mentioned earlier, the changes of the new law, now with businesses that took the PPP loans are eligible for this ERTC, which includes the first round back in 2020. And so this is the retroactive portion of the credit, where back in 2020, if you took PPP funds, you weren't eligible for the ERTC. So this is a big provision. This retroactive portion is going to apply to several taxpayers in need of funds during the pandemic. The one thing, though, that and throughout this whole presentation, you'll realize that we're still waiting on a lot of guidance with regard to the ERTC and its impact with the PPP, how to apply for it, refunds, etc. But one thing that we do know is that the companies that do obtain the PPP loans, even though now you're able to apply for the ERTC, you have to consider the wages that were used to support the payroll portion of the PPP forgiveness, because you can't utilize those same wages for the ERTC. So there's no double dipping. And that's something that we as consultants, you as taxpayers, and need to run analysis on those numbers. Next slide. So we're going to get into the credits and the calculations in a little bit. So in 2020, the one thing that needs to be considered here is that this new act did not change the calculations for the 2020 portion under the CARES Act. So all employers who qualify, including the borrowers who took a loan under the PPP, can claim a 50% credit of qualified wages up to $10,000 per employee. One thing to note here is that this $5,000 credit is annually. So once you reach that $5,000 between the periods of March 13th to December 31st, that's the only credit you're eligible for. Now come over to 2021. This is the expansion, which now if you qualify in 2021, which it also includes the PPP recipients, the new law expands the credit and allows them to claim a credit against 70% of qualified wages paid. And additionally, the amount of wages paid that qualify for the credit is now $10,000 per employee per quarter for the first 2 quarters of 2021. So an employer can now claim $7,000 per quarter per employee. So a total of $14,000 of a credit in 2021 compared to $5,000 annually in 2020. So that's going to be a huge impact for those taxpayers that do qualify. And the employee retention credit is allowed against employer share of Social Security taxes. And one thing to note is that this is a fully refundable credit. So if the credit exceeds the employer's total liability of the Social Security in any calendar quarter, the excess is refunded to the employer. Another aspect to this is that they are allowing an advance payment of this credit. The mechanics of it still need to be figured out with regard to how you get it refunded, how do you apply the 2020 credit. With the fourth quarter coming to a close and payroll tax filings being filed, we haven't received guidance on if there was a potential to pick up these credits in the fourth quarter. What we're hearing from payroll companies right now is that they are looking to amend returns, but they may come out with guidance with regard to picking up 2020 credits, possibly in the first quarter filing. So we're still looking to hear more from the government on how this gets applied and the compliance aspect to it. Next slide. So just to give you a quick example of the impact that this may have on your company, take a manufacturing company who qualifies in Q1 and Q2 of 2021. They have 30 employees. In each quarter, each employee has a $10,000 of qualified wages in each quarter. So 30 employees times $7,000 credit, which is, the computation is $10,000 of wages multiplied by 70%, which is eligible. You get a $210,000 credit for each quarter. So that between the first 2 quarters of 2021, you have a potential refund or claim against taxes of $420,000. So this is going to impact a lot of clients. And you also have to consider the interplay between, PPP and the ERTC. But this is significant cash refunds and cash that doesn't have to be outlaid for payroll taxes in 2021. So it has to be a big consideration going into this year.
And that's a good point. This $420,000, which is if they're eligible for Q1 and Q2 of this year, they can get a $420,000 credit, which is a refundable credit. That's in addition to if they go to the second draw of PPP money, they might be getting a first draw for PPP money, and they may even qualify for the 2020 employee retention credit. So there could be a lot of money on the table, but you got to make sure you qualify for all the different provisions. That's a great point, Luca. Thank you.
Thanks, Barry. Next slide. So with the retroactive changes to the retention credit, we've obviously, and particularly with the PPP loan recipients, as we mentioned, it creates immediate refund opportunities. So impacted employers with PPP loans should begin to review how their payroll costs might be covered by both provisions in order to determine which provisions to apply. And like I said, we're going to need more guidance on that from the IRS. Consideration should be given to which expenditures are needed to support the PPP loan forgiveness to determine how the payroll costs factor into that determination. Obviously, with the modifications to the PPP program over the last several months, may retroactively result in certain non-payroll expenditures being treated as expenses eligible to support loan forgiveness. And so where applicable, this may expand the opportunity to claim the retention credit, meaning, more of the wages are going to be eligible for the ERTC because you took less wages on your PPP loan forgiveness. And one of the things that Janover has been saying to our clients and to our friends is hold off on the PPP application only because of all the guidance that still needs to be rolled out. And now with this change, it's going to be even more important to analyze which expenses are going to be part of your loan forgiveness application, because we do think that there may be a situation where you may be eligible for more of the ERTC if you include more of other costs in your PPP application, forgiveness application. So that's something to consider. And I'll say it again, still waiting for more guidance. Another thing is the taxpayer is going to be able to elect to not include certain wages and allocable healthcare costs in the computation of the ERTC credit. The reason why this was done is to preserve those costs for PPP forgiveness. The reason why this election is in place is the language in the CAA suggests that wages are first applied to the ERTC. But it's still not clear how the taxpayers can elect out of this ERTC. So we're expecting guidance on how that applies. One thing to note is that we're still waiting on guidance from the SBA. If the taxpayer elects to count wages for PPP forgiveness rather than the ERTC, if it turns out that PPP payroll costs are not forgiven for whatever reason, those payroll costs can still be treated as qualified wages for purposes of the ERC. That's our thought process there. So there's a lot of moving parts here that need to be considered. Analysis will need to be run with regard to payroll costs for both PPP and the ERTC. Next slide. And like I mentioned, if you have already applied for the forgiveness, so you already put in your payroll costs and other costs that are part of your forgiveness, we're going to need more guidance from the government. And now for the PPP borrowers that have not applied for forgiveness, like I mentioned, an analysis will needed with regard to how payroll costs are allocated between both. The determination of whether those wages are better utilized in claiming the ERTC or forgiven as part of the PPP, or if they have enough total payroll costs to be able to utilize both the PPP and the ERTC. So basically, the best outcome here is to be eligible for both, to have enough payroll costs to apply both aspects of the PPP forgiveness and the ERTC. But like I said, waiting for more guidance on this.
Yeah, and look, that's an interesting point. I mean, what these tax laws are doing and what these small businesses are facing is the PPP is watched over and provided by guidance with the SBA, whereas this employee retention credit is overseen by the IRS and the Treasury Department. They work together on this, but the employee retention credit and how it interplays with the PPP, the two agencies have to get together and provide some logistics on how to handle all this. And I think that's what they're wrestling with right now. They talked about that. I was on a call with the commissioner of the IRS yesterday, and that's one of the logistic issues that they're facing right now. So we expect some guidance coming out in the near future, and we'll probably be covering that in our next webinar, some of these things that are clarified.
Yep.
Yep.
And yeah, I mean, we're already a month into 2021, and there's so much guidance that needs to come out. You know, a lot of taxpayers are looking to file amended returns on these payroll tax returns, but we don't know all the specific rules. I know payroll companies are running analysis for clients, but you know, we're still waiting. So right now, you know, we believe that you can do the 2020 retroactive credit by filing amended returns, or they might allow a catch up on the current year return in Q1 or Q2. So that'd be something to consider, and a discussion with, you know, your tax counsel and your payroll provider. Next slide. So now we're going to get into you know, how to qualify for this credit. So most employers, including tax-exempt organizations, will qualify. Qualifications determined by one of two factors for eligible employers. And one of these factors must apply in the calendar quarter the employer wishes to utilize this credit. So the first of which is a trade or business that was fully or partially suspended or had to reduce business hours due to a government order. One important thing to note is that the credit only applies for the portion of the quarter the business is suspended, not the entire quarter. So if you're shut down by a government for 1 month out of the quarter, you're only eligible for that 1 month. Obviously, unless the second factor comes into play, which is the gross receipts. So an employer that has a significant decline in year-over-year gross receipts. And what does that mean? So in 2020, like I mentioned, that credit, the calculations haven't changed. So this is under the original CARES Act. If gross receipts in the calendar quarter are below 50% of gross receipts when compared to the same calendar quarter in 2019, you would qualify. So you become ineligible if in the calendar quarter immediately following their quarter, gross receipts exceeds 80% compared to the same calendar quarter in 2019. So you don't have to maintain that 50% reduction. So once you get to 80%, you still qualify for that quarter, but you won't qualify for the subsequent quarter. That's in 2020. In 2021, it's less stringent on the gross receipts. So businesses must have seen a more than 20% drop in gross receipts in the quarter compared to the same quarter in 2019. So you're comparing 2021 to 2019. So this 20% reduction is a lot easier to obtain because of the year that you're comparing it to. 2019 was generally a good year for most taxpayers. Next slide. So here is another election that they put into this legislation. So the new law gives the option to elect to satisfy the gross receipts test by comparing the immediately preceding calendar quarter and comparing that quarter to the corresponding quarter in 2019. Now this is for 2021. So let's assume an employer who could not satisfy the gross receipts test in Q1 of 2021, so their gross receipts did not exceed a 20% reduction. they can elect to compare the gross receipts of Q4 of 2020 to the Q4 of 2019. And so if there's a drop of more than 20% in that Q4 comparison, Q1 will be eligible. And this is obviously an analysis that needs to be done. And the other thing is, same thing, we're waiting for more guidance. Is this election permanent, or will Q2 be on its own? In Q2, will you be able to make the election again? So we're still waiting on guidance on that, but it's something to consider if you don't meet Q1 to utilize Q4's numbers. One really important note, and we've mentioned this in prior webinars, members of controlled groups or affiliated service groups, you are considered a single employer. So you have to aggregate your gross receipts as well as number of employees to determine if you qualify or not. So that's another analysis that needs to be run, which I'm sure, as part of the PPP, you also ran that analysis.
Right, and Luca, those are good points. And the Treasury Department, along with the SBA, did come up with some guidance as to how you consider gross receipts. It's basically for each of the businesses, it's the way they keep their tax records. So if you're on a cash basis method of accounting for tax purposes, then you use that for tax, for your SBA calculations here, as well as your employee retention credit. So, and if you're on the accrual basis method, you use that as well. And that's the way you do your testing for each of these quarters to see if you qualify. Thank you.
Mm-hmm. Next slide. So continue on with wages. So wages in general are the wages that are subject to the FICA taxes, as well as health expenses, qualify in calculating the employee retention credit. And they must have been paid after March 12th, 2020, and they'll qualify all the way through June 30th of 2021. When determining the qualified health expenses, they include the employer and employee pre-tax portion and not any after-tax amounts. One important thing to note here is if an employee is on furlough and the employer pays for the healthcare costs during that time period, those costs are qualified here. When determining the qualified wages that can be included, an employer must first determine the full-time equivalent employees they had in 2019. So a computation has to be done of the 2019 average full-time equivalent. And now employers with more than 100 full-time employees use a different qualified wage than those with 100 or fewer full-time employees. And that's the 2020 rule with regard to 100. With the new CAA law that just went into place in December, the employee limit for determining which wages are applicable to the credit increases to 500 in 2021. So you are now considered a small employer with a 500 employee count in 2021 compared to 100 in 2020. Next slide. One really, really important thing to note here is that the ERTC full-time equivalent is different than the calculation done for PPP. So you're going to have to run two different calculations to determine if you qualify for the ERTC. I believe the PPP, it was based on a 40-hour number for full-time equivalent. The ERTC, I believe, is based on a 30-hour if you're part-time, etc. So the computations need to be done. And the payroll companies have all these reports that they're generating now to determine that. So let's move on to, so the employers who have more than 100 full-time employees, which is now increased to in 2021 to 500, can only use the qualified wages of employees not providing services. So this is employees more than this threshold. So if you're not providing services because of the suspension or decline in business, Any wages paid for vacation, sick, or other days off based on the employer's current policy cannot be included in the qualified wages for these larger employees. So basically, you can only utilize this credit for employees that are at home doing nothing and still getting paid. And like I said, that's for more than the threshold for the larger employees. Next slide. Now, for the employers that are considered small businesses, this is a great credit to consider. So with 100 or fewer full-time employees and 500 in 2021, you can use all their wages, those working as well as those not working, with the exception of if they're being paid leave provided under the Family First Coronavirus Response Act. So it's going to be a big credit for the taxpayers in need with those gross receipts drop. There are several guardrails that the IRS places, and we're still waiting for more guidance because there will be more restrictions, I believe, put in place. For instance, in 2020, under the CARES Act, there was a 30-day look-back period for determining what wages were for the ERTC. So for an example, if a bonus or raise was paid after this 30-day look-back period, it couldn't be counted. The CAA actually eliminates this for 2021. So bonuses and raises will count for the ERTC. Another no double dipping rule is employers who take the employee retention credit cannot take credit on those same qualified wages for the paid family medical leave. And another thing is we have a lot of taxpayers who receive the WOTC credit, the work opportunity tax credit, and they may not be included in the employee retention credit either. So there's calculations everywhere because of this new opportunity with the ERTC. And you know, whether you as the taxpayer run these calculations or have the payroll provider or your tax counsel to assist, these numbers have to be run because you're going to want to get the benefit of PPP, ERTC, and any other credits that you're eligible for. And the sooner you do it, the better, because once these tax filings once we get more guidance on the tax filings, we're going to want to run and file for these refunds as soon as we can. Barry, I think that's all I have. Back to you with any comments or questions.
Yeah, Luca, that's all. That's great. And these rules are still brand new, hot off the press, and the IRS and the Treasury Department, as well as us, are still reviewing it. But we think it's very important to bring this to everybody's attention that there's a $5,000 credit available for you for 2020 for those PPP eligible businesses, and possibly even a $14,000 credit this year for Q1 and Q2. And quite frankly, you have to look at your revenue in Q1 and Q2, and we haven't even completed it. So logistically, the IRS has to give us some guidance on this. So there's a lot of things up in the air. But the one thing that I also mentioned is if you take the credit, you have to reduce the wages on your income tax return for that. So there's logistically, again, there's a lot of work that needs to be done. Again, thank you very much. It's a very tough topic. It's a moving topic. I expect a lot of movement, just similar to what we experienced with the PPP last year as well. Then we're going to go on to the PPP, and the first question, we have a polling question coming up. The question is have you applied for the second PPP draw? The choices are yes, no, I don't qualify, or no for other reasons. We're finding out some businesses haven't qualified yet. And there's still a lot of reasons why. Some are looking for the forgiveness to be completed because they got first draw, and now they're looking for the second draw. So the PPP, we're still getting a lot of questions on because a lot of businesses has still not yet applied for PPP forgiveness for draw one. And they have draw two coming up. So Chris, how are you coming up with the responses so far?
All right, so we got most response. I think we got a little over 50% of responses, but it looks like that 42% yes have applied for a second draw. And then the remaining portion either don't qualify or they're not taking a second loan for other reasons.
Okay, so our next speaker is Chris. We've been talking about PPP probably almost for a year now, and why don't you take it away? Excellent.
Thanks, Barry. So the plan for today in regards to PPP, as a lot of people on this call know, if you were on with us last week, we had the first portion of this webinar series. That portion, pretty much the entire 1 hour covered PPP. So we went through a lot of stuff in a lot of detail. What we're going to do today is just talk about some key updates since last week, mainly related to the forgiveness process, and then a couple of other items to focus on. As Luca mentioned throughout his presentation, the common theme here is that there is a lot of overlap between PPP and ERTC. You do have to look at both of them kind of together rather than look at them both in two different silos, because what affects one most likely will affect the other. So just as a quick overview related to the to PPP second draws, as most people know, businesses are eligible to receive a second draw of PPP now. Now, there are a couple of criteria as to how to qualify for that second draw. We have them listed on the screen here. The first is, and this is a question we get a lot, this first one, because the business must have no more than 300 employees at the time of the loan application, including affiliates. This is a question we get a lot because the guidance is a little vague in how they describe that 300 employees. We've had questions, is that at the time of the loan app? Is that an annual average? That is 300 employees at the time of the loan application. The second piece, which is the more difficult piece to accomplish, is that the business must have experienced a decline in gross receipts of at least 25% in any one quarter of 2020 compared to 2019. And that's including affiliates. So that's looking at an affiliated group of companies. As a total, they must have experienced a decline of at least 25%. Now, just as a refresher, as Luca covered, the threshold to meet that 2020 ERTC is a 50% decline in gross receipts. So most likely, if you qualified for that, by default, you're going to qualify for the second draw, the PPP, and that 2021 credit is a 20% reduction. So there are three different revenue reduction numbers to keep in mind here. So just to keep that all in order, ERTC 2020 is 50, PPP second draw is 25, and the ERTC 2021 credit is 20. Moving on, the next criteria is that the business must have spent or will spend all funds from their first draw. The next is the business must certify economic uncertainty makes the loan request necessary to support ongoing operations. This is a certification that happens on the application to get the loan, not on your forgiveness application. And what we've been reading is that there is essentially a safe harbor for loans under $2 million. Essentially, the safe harbor automatically qualifies. It doesn't force the business owner to prove economic uncertainty in order to get forgiveness. For those loans over 2 million, if you do have a loan over 2 million, you probably are aware of the form 3509, which is that economic uncertainty form. That's a form on top of your normal 3508 forgiveness application. You have to fill out this 3509 form that asks you for a lot more information. And that's apparently to help the SBA gauge the economic uncertainty piece of the puzzle. A really important one here, the deadline to apply and receive funds is March 31st, 2021. This is another question that comes up a lot because businesses are saying, because essentially when you get the money, that's when your covered period starts. And that covered period could be anywhere between 8 and 24 weeks. So we have been getting a lot of questions from clients asking, should we hold off getting the money until we really need it? Because when you get the money, your covered period begins on that day. So Barry and I have done a lot of talking internally about this. The money is probably going to go pretty quick, not as quick as it went the first round. The first round did have a much larger pool of funds, but there were a lot more businesses who were eligible for it. So while it's not going to go as quick, we do expect the money to go pretty quick. So really speak to your advisor. As a business, come together and try to determine what the best timing is there for you to apply. But just keep in mind, March 31st is your the last day to receive funds. Finally, yep. Yeah,
I was
something.
going to say, Chris, that's a good point. And basically, there are people who are weighing when to go for it and strategizing when they should apply.
Mhm.
One, you have to balance, because the SBA rules, the rules say that the banks have to provide money within 10 days of the application. So they don't give much time for the banks to process the applications. So the banks are eager to move these along and get a complete application. So the most important thing is, when you submit your application, make sure it's as complete as possible. One of the best things is go to the banks that, if you apply for original PPP loan, go to the bank that you got your first loan with, because they have a lot of the paperwork and they approved the loan already. So it should expedite everything. So just make things easier on you. And just make sure, watch out for the 31st, because that's the last day to apply and receive money. And it takes 10 days to put back on it. Thank you, Chris.
Yeah, and Barry, on that note, regarding the documentation to submit to the lender, that is something that's been coming up a lot, just because the SBA guidance does list out criteria for certain documentation that's needed for the second draw. But our experience so far over the past week or so that the program's been open, we have seen that lenders can ask for and require as much support as they want. So just because the SBA has certain guidelines in place for like the minimum for the loan documents that they need, we have seen lenders. I know Chase is one that has been asking for a lot of information from the borrowers in terms of getting the second draw. So they're being a lot more kind of tight on the requirements that from each borrower. Finally, the last piece here is that loans are capped at $2 million or $4 million for affiliated companies. So for a group of affiliates, if let's say there's 3 entities, each one is eligible for $2 million each, for $6 million total, they're going to be limited to a $4 million PPP between the 3 entities. So just keep that one in mind. Moving on here, we did cover this last week in our webinar in great detail, but this is something that we felt, so forgiveness applications, updated forgiveness applications rather, did come out last week, and they did provide a bit more guidance on these new non-payroll costs. And the reason why we're including this here today is because there have been slight updates, as well as in tying it into the ERTC. This is going to be really important when you're looking at your covered period and trying to figure out what payroll you're going to be using for PPP versus the ERTC. With these new, I'm putting new in air quotes, with these new non-payroll costs that are eligible for forgiveness, this does give you a little more leeway and the potential to have to use less of your payroll in terms of your PPP forgiveness. So just as a quick refresher, eligible expenses since the first round of PPP have been certain payroll expenses, utilities, rent, and mortgage interest. Now, with the passage of the CAA, they did make retroactive changes. So everything you see here, you are able to take related to your first draw as well as your second draw. So those are operation expenditures. Operation expenditures, this we were previously calling software expenses, but this is business software or cloud computing services that facilitate business operations, product delivery, processing, payment or tracking of payroll, HR, sales or billing, tracking supplies, inventory records, and expenses. So basically any software that is critical to your business operations, it essentially is eligible for PPP forgiveness. With this, you have to provide a copy of an invoice or a purchase order that shows they were paid during the covered period, and you need receipts, canceled checks, or account statements showing that as well. So they do request a lot of support for this. Next is property damage. Basically property damage that during the vandalism and looting that occurred during the 2020 public disturbances that were not covered by insurance. you are eligible to take those expenses. Moving on, supplier costs, and this is a question we're getting a lot. Basically, we know as much as the guidance says as of today. So what it says as of today, expenditures made to a supplier of goods for the supply of goods that are essential to operations at the time which the expenditures were made pursuant to a contract or purchase order that was in effect prior to your covered period are eligible for forgiveness. So for a supplier of goods that are essential to your business operations, if you had a purchase order in place prior to covered period, and basically you essentially have to pay it during the covered period because it was due, those are eligible for forgiveness. And then really important for the supermarkets out there, if the goods are perishable, then if the order was placed during your covered period, you are able to take them. Finally, worker protection, any expenditures that facilitate the business adapting to the compliance with the requirements by the DOH, CDC, or OSHA, or for the maintenance of standards for sanitation, social distancing, or any other worker safety requirements related to COVID. That would be for the businesses who had to put up the, plexiglass, for example. Maybe they bought a bunch of masks, sanitizer, kind of anything they had to really change in their business in order to comply for worker or customer safety. Moving on, as I mentioned last, I think that was Tuesday now, on January 19th, we did finally get to see updated forgiveness applications. These are applications that are for the first draw as well as the second draw. So for most people who already got their forgiveness applications in, I don't expect, I don't know, Barry, if you have an opinion, but I don't expect the lender is going to require you to refill out these new applications. But as of now, anyone who's submitting a forgiveness application, it does have to be one of the updated ones. So there are 3 key applications. We're not covering everything here because a lot of the application is similar to how it was when we had first seen them a couple months back. What we're covering here are kind of key items that we want to point out related to each one of these, whether it's a key change or something key to highlight. The first is the Form 3508S. That's the 3508 short form. When we met last week, we did mention that we were expecting these forms to be released soon. And for any loan amount less than $150,000, there would be a 1-page certification, which is this 3508S. So that application did come out. It could be used for loans under $150,000. Previously, that was $50,000, you may remember. Your businesses are only required to report amounts spent on payroll costs. So it really is a 1-page certification. You don't have to include any FTE analysis or anything like that. However, that application does further give us guidance that if a loan is under $50,000 or under, those loans are exempt from an FTE reduction. So if the business got under $50,000, essentially the loan is automatically forgiven. They're not going to ding the company for having a reduction in their FTEs or their salary and wages. For loans between 50 and 150, they do have to attest to 2 items. So it's not automatic forgiveness for loans between 50 and 150. First, they have to attest that they didn't reduce salaries by more than 25% compared to the most recent quarter. And they either have to attest they did not reduce number of employees between January 1st and the end of the covered period. So they didn't reduce FTEs, or they were unable to operate at the same level of business as before February 15th due to compliance with COVID. So if the borrower cannot satisfy these requirements, they're not able to use the 3508. They have to use the 3508S. They have to use the 3508. So just keep that in mind. Just because you got under 150,000, if you're between 50 and 150, it's not automatic forgiveness. The 3508EZ, this is for loan amounts greater than 150, and they can certify one of the following: that annual salaries or hourly wages were not reduced by more than 25%, and they didn't reduce their FTEs from January 1st to the end of the covered period, as well as either that or you didn't reduce salary and wages and you were unable to operate at the same level of business activity as before February 15th due to compliance with COVID restrictions. This is largely unchanged. The only difference from the first step is that I think there was a third option on that 3508EZ that said if you're a sole proprietor with no employees, you could use that application. Finally, the 3508, key points here, the FTE reference periods are still unchanged. So even for the second draw, you're still comparing to your FTEs in that January to February of 2020 period, as well as that February through June of 19 period. And then the salary and wage reduction, previously, for the first draw, it was looked at, they looked at Q1 of 2020, the average salary and wage during Q1 of 2020, and that compared to your covered period. Now for loans before June 30th of 2020, they remain the same. For loans after June 30th, you have to compare your average salary and wage during the covered period to the most recent full quarter before the covered period. So that is a slight change. It doesn't really affect much related to the first draws, but it will affect the second draws.
And Chris, I think I think the biggest question that I'm fielding from businesses is when they go on the bank portal to ask for forgiveness. One is, when do they go and apply? And two, what application or what form should they be using? I think I was suggesting and I was recommending to businesses to hold off until January, expecting a tax law change, changing the rules. They did change the rules and it came out in December 27th. And now the SBA and the Treasury Department are reacting to it. So I still think it makes sense to be a little more patient on it. Probably if you're probably $150,000 or less, it may make sense to go and do it right now and use which form. But in any event, on February 4th, we'll be going over which we recommend is the forms and the process to use. So stay tuned.
Thanks, Barry. Yeah, that's a really good point. Finally, tax implications of PPP forgiveness. And this is something that's actually a really funny story. So originally, IRS had taken a position that expenses could not be deducted if they were paid with forgiven PPP funds, which essentially made PPP taxable. I think everyone's on the same page now, and we covered this in a lot of detail last week, but the CAA confirmed that those business expenses would be deductible. And they're non-taxable for federal tax purposes. Now, it's funny because last week, when we did this webinar, this slide only said that forgiveness income is non-taxable income for federal tax purposes. And I think we specifically mentioned that New York State had decoupled and it was taxable for New York. And I think, Barry, was it like less than an hour after we finished our seminar, New York State came out with an announcement that said that New York State was also going to be considering it non-taxable income. So
that's correct.
It's funny, but yeah, the biggest change from last week to this week is that New York is no longer decoupled in terms of the recognition of the income. That's pretty much all we covered for PPP this week. I know we did go through everything really quick. Like Barry said, we will have another update on February 4th. That's going to cover any key updates to ERTC that we've seen as of from today through then, as well as any key PPP forgiveness or PPP application updates that we need to cover, as well as some business tax provisions. Barry, anything else you want to add before we hand it over to Amanda?
Yeah, no, I don't. Amanda, I would like to introduce Amanda, a tax manager in our firm, and she's going to be covering the individual tax provisions. Take it away, Amanda.
Thank you, Barry. Good morning, everybody. I'll be speaking today about the changes to the individual tax provisions as a result of the new COVID-19 Tax Relief Act, which is more commonly known now as COVIDTRA. One of the first items I'd like to cover is the new recovery rebate. Under the CARES Act, the first economic recovery payment was $1,200 per taxpayer, $2,400 for married filing jointly in 2020, plus $500 for each qualifying child. Now, under the new COVIDTRA tax relief, the provision provides for a refundable tax credit to eligible individuals in the amount of $600 per eligible family member. The credit of $600 per taxpayer is $1,200 for married filing jointly. And the credit is also in addition for $600 for each qualifying child. The credit phases out starting at $75,000 in modified adjusted gross income if you're filing single, $112,500 for head of household, and $150,000 for married filing jointly. A non-resident alien dependent of another estate or trust is not considered an eligible individual. This credit is available on the taxpayer's 2020 tax return. So taxpayers that receive these advance payments that exceed the amount of their eligible credit will not be required to repay any of the payments that they received. But if the amount of the credit calculated on their 2020 return exceeds the amount of the advance payment, taxpayers will receive the difference as a refundable tax credit. If you didn't receive these advance payments from the first round of stimulus payments from the CARES Act or second round from the COVID-19 Tax Relief Act, your 1040 is going to be adjusted accordingly. Currently, Biden is working on a stimulus plan to increase the second round of payments from $600 to $2,000 for taxpayers and their dependents. He's also looking to increase unemployment benefits from $300 a week to $400 a week. Chris, next slide, please. One of the next topics I'd like to cover are pension distributions. Just a quick side note related to required minimum distributions. So in 2020, a law was passed in March that suspended the required minimum distributions from being taken in the 2020 tax year. This suspension, though, was only for 2020. Required minimum distributions must be taken in 2021. Under the CARES Act, individuals were allowed to withdraw up to $100,000 from their retirement accounts, penalty-free, as a coronavirus-related distribution prior to December 31st, 2020. These qualified distributions are not subject to the 10% early withdrawal penalty for taxpayers under the age of 59 and a half. The income, though, is still required to be reported, but it can be recognized over a 3-year period, starting with the 2020 tax year. So that would mean that taxpayers could recognize $33,333 of income in 2020, 2021, and 2022. The taxpayer has the option of returning these distributions to their retirement account by the end of the 3-year period, which would avoid the recognition of this income. We just don't know as of yet how the repayment of the distributions will be treated if the amount is repaid in year 3. This could be very beneficial, and it has been extended over the COVID-19 Tax Relief Act. These distributions are considered a qualified disaster distributions for individuals in a disaster area, which is pretty well the entire United States, and for taxpayers that sustained economic losses related to COVID-19. Chris, next slide, please. There have also been changes made to charitable contributions for 2020 and 2021. Under the CARES Act, an above-the-line deduction was added for the deduction of charitable contributions for taxpayers that are taking the standard deduction. Those that are taking the standard deduction in 2020 are able to claim up to a $300 deduction for cash contributions made to public charities. For taxpayers itemizing their deductions, the 60% of adjusted gross income limitation has been eliminated. Previously, if a taxpayer had adjusted gross income of $100,000, they would be limited to $60,000 of a charitable contribution deduction. Now, taxpayers would be able to deduct 100% of their charitable contributions that were made. Contributions to donor advised funds are not eligible as part of the allowed charitable contributions. Under the COVID-19 Tax Relief Act now, the above-the-line deduction has been increased from $300 to $600 for the taxpayers that are taking the standard deduction. And for taxpayers that are itemizing their deductions, they will continue to be able to deduct 100% of their charitable contributions made in the 2021 tax year. Next slide, please. Some additional provisions under the COVID-19 Tax Relief Act are the following. The $250 eligible educator credit for the above the line deduction has been expanded to include expenses that were paid or incurred after March 12, 2020 for acquisition of PPE, which is the personal protective equipment, disinfectant, and other supplies that are used for the prevention of the spread of coronavirus. In determining the refundable portion of any 2020 child tax credit or earned income credit, taxpayers may elect to substitute their earned income from 2019 if their earned income is greater than their 2020 earned income. For joint tax returns, the choice of the 2019 or 2020 earned income is based on the combination of both spouses' earned income in each year. Business expenses incurred during 2021 and 2022 related to food and beverages provided by a restaurant are no longer subject to a 50% reduction. This is hopefully to help the restaurant industry by getting more people to go out and dine safely. There's also the solar investment tax credit, which has been extended through 2023. The credit was originally supposed to be phased out at the end of 2021, but now the tax credit will save homeowners 26% of costs for any solar investments for 2020, 2021, and 2022. The savings will decrease to 22% in 2023, and then will no longer be available in 2024. Next slide, please. The CARES Act emergency financial aid grants made after March 26, 2020 will not be included in the gross income for college students and university students. For those that received an economic injury disaster loan, more commonly known as the EIDL, the forgiveness of this loan is not going to be included in gross income, and the expenses paid using the EIDL funds are going to be deductible, which is similar to the PPP now. Individuals are allowed to roll over their unused flexible spending and dependent care accounts from 2020 to 2021, as well as from 2021 to 2022. And finally, the COVID-19 Tax Relief Act continues the 7.5% of adjusted gross income threshold to be applicable for medical expense deductions going forward. Right now, so any medical expenses are deductible only after they exceed 7.5% of your adjusted gross income. This right now is a continuation of what the law previously was, but they have now made a note that this is going to continue until the law then changes. And now I'm going to turn it back over to Barry for some closing remarks.
Yep, thank you. And we have one more polling question. Chris, the polling question. Would you like Janover to contact you to assist with any of the PPP or the employee retention tax credit? As it is, let's go over the next slide, which is to summarize some of the things that we talked about. Is what businesses should be thinking about right now. One, for the employee retention tax credit, you should be reviewing your quarterly gross receipts and determining if you're eligible for the employee tax retention credit for both 2020 and 2021. You should be looking towards your PPP, looking to see if you qualify for the second draw, as well as how much. And you should be looking towards reviewing a timing schedule of when you should be applying for PPP forgiveness on the first draw. You should be speaking with your tax advisor to maximizing the employee retention tax credit with the PPP to maximize the PPP loan and forgiveness and the employee tax credit. You should be reaching out to your payroll processing company, whether ADP or whoever you use, to figure out how they're going to implement it, because they're working on that themselves, because this is a relatively new process for them. And these are some of the things you should be looking out for. And these are the next steps and the takeaways from today's program. We have, I want to thank everybody for attending and save the next webinar. One is on Thursday to go over the real estate tax outlook or real estate outlook. And also on February 4th, we're going to be continuing the webinar series, and we're going to have additional updates on the employee retention credit, the PPP, as well as the business tax updates. Thank you very much and have a wonderful day.